Welcome back to the Bull Put Spread Masterclass. My name is Stephen Cox and I'm the CEO of Share Navigator, and I'm a full-time options and futures trader. In this video, we're going to show you how to place a bull put spread with an online broker. We're going to teach you how to go about picking the strike price and the expiry. And we're going to use the SPY example, the $625 stroke $621 bull put spread. We use this example from the very beginning of this course, and if you've missed the course, please go to our website, sharenavigator.ie, click on option trading courses and click on the bull put spread course. It's totally free for you to look at. If you like the content in this video, please like, subscribe and share our channel. Again, it really does help us provide more free content for you option and future traders out there. Okay, so how do you go about picking the strike price and the expiry for the bull put spread? And this comes down to a trade-off. What do you want more? Do you want a higher probability of actually making the profit with less credit received? Or do you want more credit income and you're happy to take a higher risk? In other words, your probability of profit will be lower. And everybody is different on this. Our preference is taking a higher probability of profit. We have a 93% success rate with option trades like this because we take trades with 80% or more probability of profit. It means we're taking in less credit, but we're happy to do that. We'd rather put the odds of success in our favor. So you will be considered least bullish like us when you choose strikes where they're both out of the money. In other words, for put options where the strike prices are well below where the share price is. For SPY, we picked the 625 and the 621 strike prices. Remember, SPY was trading at 665, so this gave us a lot of wiggle room for the share price to fall and we would still make a profit. So you're least bullish in that scenario, but your probability of profit is at its highest. You'd be moderately bullish if you picked a strike price that was between, or the share price was between the two strike prices. Your probability of profit is going to come way down, but you're going to get a bigger credit in. And then you're even more bullish when both of the put options are in the money. We wouldn't recommend that, by the way. You get a significant credit, but your probability of profit is going to be much lower. And finally, as regards picking expiries, pick expiries with 30 to 60 days to expiration. So here's our example with SPY. We're looking at the put options for the December 19th expiry, which was 42 days away. So in order to start the trade, we're going to click on the bid price at the 625, which is 548. And then we're going to click on the ask price at the 621. And look what happens to your screen. So what you can see here now is the trade at the very top. You can see it saying there's two legs to the trade. It's telling you what your break-even price is. And on the right-hand side, it's telling you what your order is, and it says it's at a credit. Then it's outlining the two legs of the trade. You can see that we're buying the 621 put and we're selling the 625 put. And then underneath that, it's giving us our performance profile. It's telling us what we can lose, what our break-even price in, and what's our maximum return. Now, we showed you how to calculate all this in our previous video, but it's nice to see that the broker does all this for you. But the key thing I want to highlight to you here on this screen is look at the probability of profit. It's 87%. That's the benefit of picking strike prices way out of the money with the bull put spread. Let's discuss the rest of the order window. At the bottom of the order window, you're going to see the profit and loss table. So on the left-hand side of your screen, you can see it automatically defaults to expiry. And what we've done for a max move of 10% in the underlying share price SPY. And you can see what our profit or loss would be for different scenarios down at the bottom. But you can also change the last trade date from December 19th there, for example, to November the 20th. You're seeing that on the right-hand side, and you can see your profit and loss scenarios for the exact same outcome in the share price change dramatically. And the reason for that, folks, is that at expiry, there's no time value left in any option. But as you can see, when we choose the November 20th expiry, there is time value. So therefore, the profit and loss dynamics change greatly. And this is this system here automatically calculating all of your Greeks for each potential outcome and what the potential option price will be and your profit and loss. This is a great feature in the online brokerage platform. Okay, so if you're happy to place the trade, you would click on order in the top right hand side, and this is the screen you will see. Now, this is really important for you to pay attention to here. So first of all, in the top half, you're getting the trade described to you again. It's telling you what option you're buying and what option you're selling. If you're still happy with that, notice that the order is to buy, okay? and it automatically defaults to a quantity of 1. You can change that to 2, 3, or 4 if you wish. And the order type you can see is set to limit. Now, this is where you need to pay attention, because look at the limit price then, which is highlighted in red. Now, we filled it in on the right-hand side. This is what you need to pay attention with. You need to put in a minus number before that, because it is a credit trade. We're taking in money, and you put in your limit price, for example, of minus 0.5 or whatever that number is for the particular trade. And the reason for doing that, if you made a mistake, for example, put in 0.5, you will still get filled at the trade. And in this particular broker, they'll fill you at the best available price. But depending on the time of day you're trading options at, sometimes the bid-ask spreads can be wide and you mightn't get a favorable price. So that's why we much prefer you dictate the credit you're going to receive. And then finally, we'll leave it as a day order, and then we'll click on preview. So the trade preview is, again, just a last chance saloon really for you to check the trade. Is it sure you want to put this particular trade on? Have you got your amount of contracts correct? And then you're checking your margin. And for a bull put spread, the margin is negligible because the risk is defined. So if you're happy to go ahead with the trade, you just click on submit buy order. And this is what your position will look like in an online broker. You can see we've got a drop-down menu. It's calling it the SPY bull put spread. The contract size is 1, and it's telling us what our current value is in the trade and what we're up and what we're down. But then the 2 legs of the trade, when you click on the drop-down arrow, are expanded, and you can manage those trades separately if you wish from there. And this is what this trade looks like just 3 days later since we placed it in our trading account. You can see we're up $26 per contract. That doesn't sound like a lot, but if you go back to our original videos, remember our return on investment. It's significant because we're not risking a lot of money on this particular trade, and our probability of profit is so high in it. Remember, it's 87% chance of winning, and we're already gone into profit. And what that is the benefit of time decay already working for us. The beauty of the bull put spread, a high probability strategy. Okay, to summarize the bull put spread trade, picking the strikes. Further out of the money you go, the higher probability, the lower the credit you receive. Which one matters to you most? Everyone's different than this. The more you go out of the money, the better chance you have of winning. And then the more profit you want to make, you've got to go in the money with the put options. And everybody is different than this. Personally, I prefer the high probability way. And finally, just pick expiries 30 to 60 days out. So that's it for the bull put spread. It's very simple to buy a bull put spread on an online broker. Next video, we're going to show you how to manage the trade. Maybe you want to close it down early, take the profit off the table. Maybe you want to roll the trade out for a longer period of time. We're going to show you how to do that. And finally, just if you want to get access to the bull put spread course from start to finish, please go to our website, sharenavigator.ie. Click on option trading strategies and the bull put spread. The course is totally free, and you can start again. You can revisit the course at any stage you wish. And finally, if you like the content in this video, please like and subscribe to our channel. It really does help us to provide more content on an ongoing basis in relation to options and futures trading. Okay, thanks and bye for now.
Are you a frustrated options or futures trader?
That's why we built the options trading roadmap you need. Stop relying on fragmented clips. The next step is a structured program. We start with the foundations, from the exact definition of a put to the role of delta and theta. But unlike simple videos, we provide the full learning environment. Every key strategy is supported by text, video, quizzes, and live examples, so you can test your knowledge and see exactly how it works in the market. This structured approach takes you from beginner concepts to a confident understanding of basic to intermediate options strategies, and it's 100% free.
Visit www.sharenavigator.ie. Click on Options Courses from the menu. They are all free.